As I always like to say, folks, give me a second. Let me make sure that we're streaming properly on all the various social media accounts. It's nice that I'm going to be interviewing a fellow CFA charter holder because apparently, it's you shouldn't be advertising you're a CFA charter holder on social media because we don't know what we're talking about, clearly. For those that
Yeah.
are watching this live on YouTube, X, LinkedIn, or whatever platform, whether it's on my accounts or Andrew's accounts, we can see your comments, which means if you want to engage live while we're chatting for this roughly next 45-minute period here, post your comments, your questions on whatever platform you're on. I'll try and bring it up. We'll make this as interactive as possible. As always, this will be an edited podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, and Spotify. I actually came across Andrew from his Substack, and I figured out, said to him, why don't you come on my show? We'll do a little back and forth here. So, and he happens to be going through a transition himself, career-wise, which we can touch on as well. So, with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Join me for roughly 40 minutes is Andrew O'Connell, CFA charter holder, and FRM, Financial Risk Manager, I think is the acronym there.
That's correct. Yep.
So, Andrew, introduce yourself to those listening and to me. Who are you? What's your background? What have you done throughout your career? What do you do now?
Yeah. What's going on? First of all, thank you so much for having me on the program. Really appreciate it. Yeah. In terms of my background, who I am, I graduated in 2015 from university. I graduated with a degree in economics and finance. I also played Division One tennis in college. Around junior year of college, I absolutely got the markets bug. Originally, I wanted to play pro tour tennis, and I was super obsessed. That's been a theme throughout my life. I pick things up, and I really just get obsessed with them. When I realized pro tour tennis wasn't going to be a thing for me, I really devoted all that attention to the financial markets and really mastering this craft of trading and really trying to become one of the best in the world at it. I did not go to a target school. I did not have a 4.0 GPA. So I ended up really just like, by luck and happenstance, I was able to get my first role at the Vanguard Group, super large mutual fund company. I started off there as a brokerage associate, and I was really just helping customers prepare for retirement, helping them build Vanguard portfolios. And my whole job was focused on really just long term investing, putting people in Roth IRAs, that sort of stuff. Awesome role for coming out of college, but I really wanted to get to the trading side and the fund management side. And I knew early on that is where I want to go in my career. I was able to make my way onto the fixed income trading desk at Vanguard, and that was just an incredible experience. I really got to learn a lot about the bond market. I had like my four monitor setup, my Bloomberg terminal, all of that good stuff. Just an amazing experience. I got to rotate through a bunch of their desks. I ended up making it into their investment management development program, and I was the one internal hire that was selected for it. So it was really a goal I had been working towards for years. Wanted to get to the front office, wanted to do all that stuff, become a portfolio manager, the whole nine yards. I ended up getting kicked out of the program before it even started due to my personal trading and really just compliance violations I was racking up. So yeah, I got kicked out of the program, was super upset, devastated. I ended up going full time in trading. I had been trading on the side, doing pretty well. I was trading news events at first. And then as I started studying the CFA curriculum, I layered in fundamentals to my trading process, layered in some macro and some economics as well. I never traded with charts, was more of a swing and position trader, doing pretty well at that. I ended up going full time. Once I went full time, I hit some major snags. My psychology just completely shifted. And I had some really bad experiences with trading and investing. At one point, I had to sell my car. One point, I was waiting tables at a restaurant. It was horrible. Had to go back to full time work for a couple of years. And I was able to string together some awesome performance in the U.S. Investing Championship. So last year, I placed ninth in my division with a 103.5% return. This year, I'm in first in the contest in my division with an over 400% return. So yeah, really just riding the wave right now, trying to do my best. And I actually just put in my 2 weeks at my day job yesterday.
Let's talk about the U.S. Investing Championship. I've actually interviewed a few people that have been a part of that. For those that don't know exactly what it is and how many people tend to compete in that, maybe give a kind of an overview of it.
Yeah, so the high level overview, there's four different divisions. There's a money manager division, which is split into two parts. One is stock trading only, one is stocks as well as futures, options, derivatives, etc. And then same thing, there's a lower tier division below $1 million, where and they have the same breakouts. One is just stock trading only. The other is you can use options. It's called the enhanced growth division. I'm currently in the enhanced growth division under $1 million. That's the division that I competed in last year. Competing in there again this year, and then the goal is for next year move up to that money manager division and compete there.
Is it fair to say that if you're going to try and compete, you have to take on some real serious concentration in quotes risk? I mean, with the virtual account.
Oh heck yeah, and it's not a virtual account, so you're trading your own money. But yeah, I would say by and large, if you want to place well in the contest, or if you want to try to win the contest, for sure, you're going to have to take on a lot of risk. I know some people go crazy trading margin. I actually don't use margin, but I do trade options, so I get leverage from the options as well. I don't think there's anything wrong with competing and just like having a strategy that runs and being consistent in the competitions. And that has sort of been my goal, just get on the leaderboard multiple times, be consistent. But yeah, if you want to have a good shot at winning this thing, like especially in the under $1 million division, there's definitely people just kind of like shooting for the moon. So I think in order to win the thing, it's almost like playing a golf course. You got to play the course to perfection. It's got to be your year. And yeah, in my strategy, I'm very concentrated, and I'm a big risk taker as well.
Do you find that because it's a competition, you're taking on even more risk? Meaning, would you have done the same trades had it not been for it being a competition?
I think that's a great question. I think with the competition as well, there's more accountability. So even though you're really trying to, it's like an absolute return competition. It's not a risk adjusted returns competition, which if you're a fund manager, that's really what you're striving for, good risk adjusted returns. And this is really just absolute. So yeah, you're definitely taking on risk. I would say for me, it hasn't impacted my risk taking until maybe this final stretch of the competition where it's the final quarter, I'm in first place, that sort of thing. That's where those thoughts really start to creep in. But to be honest, my goal is really to be consistent over multiple years. Right now, I'm 31 years old. My goal is to really just build a track record over the next, 20, 30 years, something like that. So I try to just like, not let those thoughts creep in my mind of like, oh, I have to win this thing, because honestly, I could try my best to win. Someone else just, hits a moonshot, they beat me. Anything can happen. It's all probabilities. So I try not to let that impact me too much.
So I think you actually hit on sort of the at least the core issue from my perspective, which is, and as I think it's something that every trader has to at some point wrestle with if they're honest with themselves. How much of
Yeah.
performance is the moonshot luck versus the actual skill that's repeatable?
Yep. Yeah, and that's where I think the risk adjusted returns come in, because I completely understand. Like, I'm a retail trader. The things that I can do are a lot different than like if I was running a mutual fund. And, because I used to be on that side at Vanguard. So I know like the game that they're playing, it's still an amazing game, but they have like these really tight rule sets that they have to fall under. So within that, you can still have amazing performances. Like if you're a bond fund manager, the bond fund returns -6% and you were -3% on the year, -4. And like for you, that's being a rock star. Whereas, for someone like me that's a retail trader, I'm not on the institutional side. I'm in an absolute return competition. It's really just different games. But I think as you progress, you really do want to focus on like the risk adjusted returns side. I think on social media and a lot of that stuff, I think a lot of that gets just lost in the sauce. But yeah, my goal is just to keep moving forward, keep doing my best.
How many positions do you have on currently?
Currently, I have two positions. So right
Okay.
now, I had one coming into today's session, a small position. I was mostly in cash actually. I have a small TLT position on the books. Really just playing for some mean reversion there. Bonds have gotten absolutely crushed, especially with that Trump victory. The bond market essentially just like fell out of bed as soon as he won. So I put on a small position in TLT, nothing that's going to move the needle too much. And then with these MSOS cannabis stocks, that's a trade I've tried multiple times this year. The most important thing for me is taking my stops when they hit. So I had gotten stopped out of MSOS a few times trying to trade this thing, and I actually just re-entered it this morning. My cost base was like $4.24. I'm really just playing this thing for a capitulation washout. And so we'll see how that goes. But yeah, for me, I can be in 100% cash when I want to be, and that's perfectly fine. I like being in 100% cash. When things are going really well for me, I can get fully exposed. I never use margin. So yeah, it's really that's what I love about being an active retail trader. I can be zero exposure. I can move things around very quickly.
Did I hear you right when you say you don't trade charts?
So that was when I first started.
Okay, I was gonna
I
say.
had a lot of success when I was just reading news. So I was reading when I first started, I did not know where to learn. My mindset was like, I want to be the best at trading and investing. I don't know where to go. I didn't have social media when I first started. I jumped on social media later in life, and I was really just like, where can I learn? So I started reading Bloomberg and Wall Street Journal, and I was really just trading off of what I read. I only started using technical analysis maybe 4 or 5 years ago. I layered that into my approach, and I find it works very, very well when you combine it with fundamentals and when you combine it with news. That's where I like it the best. Like there's some traders out there that they can get fully concentrated in a position where it's like, I ran a scanner this morning. It was like a top mover. The thing is like, a biotech, blah, blah, blah. I've never even heard of it. And I'm going like all in on this stock. I can never do that. In order to really get concentrated in a position, I have to see the technical picture. I have to know the story of what's going on, and I have to know the fundamentals as well. That's just kind of how I'm made up. I can't just go into random stuff.
I think we have to define when you say look at the technicals what that actually means, because some people think of technicals just in terms of chart recognition. Some people think of it just in terms of indicators. What does that mean to you looking at the technicals?
Yeah, so I think this is a great point. I think a lot of people take all of these strategies, whether it's fundamental analysis, macro, or technical analysis, they take these strategies way too literally. Meaning, in technical analysis, they think like, oh, because a stock is in this specific pattern, that means the stock has to go to this specific level. And like, I know the stock's going to rally 30%. And like, they use it really as a prediction tool. And I think technical analysis, aside from maybe volatility contraction patterns, like, they're just horrible prediction tools, just, straight up. But I do think technicals are awesome for getting a lay of the land in a stock and seeing what is currently happening in that stock. So really just seeing like, is this stock, when I look at the chart, is it being sold or is it being bought on a net basis? I think if you were to just layer in technical analysis and just look at it from that approach, is the stock in like an uptrend or a downtrend? Are people selling it or are they not? Are they buying it? I think that's the most important thing. And I think 90% of any edge you can get from technical analysis is really just that. So yeah, I use that primarily. I go a little bit more in depth. Like I use the market profile just to see like what levels were the most highly traded levels on the chart, because I think that just helps show you where investors are and potential cost bases of those investors, that sort of thing. But that's I try to take like a common sense approach to all these disciplines, and I know like I see some people and they're doing technical analysis the day ahead of like a big binary event. Like it'll be like, I'm doing technical analysis on the stock and it reports earnings tomorrow. And that is where technical analysis pretty much has no edge. So yeah, I think with all these strategies, they all have to be taken with a grain of salt. And they all have their time and place.
Since you say you only have two positions, and you're talking about technicals, how do you even determine what to apply the technicals to? It's not just a function of a chart says this is a buy or a sell. It's also the opportunity set.
Yeah, so I think, in terms of like how do you know what to apply the technicals to, a lot of what I'm doing is I'm tracking momentum in the market. So I have a bunch of dashboards, like Excel models. Like really over the last 10 years, I've just gone crazy with modeling. And what I do is I'm trying to find within the marketplace, like I'm one guy, up until recently, like I'm working a job as well. So for me, it's like I want to see at the highest level where are investors allocating capital to, and where are they withdrawing capital from? And does that sort of line up with like my high level understanding of what I think should be happening? Sometimes it does, sometimes it doesn't. I always try to go with what the market is actually doing rather than my own opinion. But yeah, I'm looking at what is actually happening. Like these large institutions, they're the ones that are moving the market. So I need to be in tune with what they're doing. And then from there, that gives me a little bit of insight. It's like, where do I want to start hunting for potential opportunities? If I know money is being allocated to a certain group, and also through reading the news and just being, I love reading and I love reading about financial markets. Like, if I can understand why that capital might be moving there, that's when I really break open the chart and I see like where do I want to interact with this asset. And like I come from a tennis background. I used to play tennis and I used to be a tennis instructor. And really in tennis, you want to have the same contact point with the ball. You want to hit right out in front of you. And for every shot, there's a specific contact point. And I think with technical analysis, it's really like if I were to look at a chart of a stock, there might be 5 candles on that chart where I would have interacted with the stock, whether it's a buy or sell. So I want to make sure that those interaction points are there and I'm executing my trade when it's at one of those interaction points where I can take a tight stop on the trade, and when I'm wrong, which I am a lot, it doesn't absolutely just demolish me.
Let's talk about being wrong a lot. You mentioned psychology. Um,
Yeah.
it's nice to feel those positive streaks, but sometimes you just can't get out of your own way. Again, could be also luck, bad luck in that case.
Yeah.
What do you do when you have these kind of string of losses?
Yeah, so I actually had one recently in October. I had just, with my system, I'm expecting to have a win rate somewhere around like 50%, somewhere around there. Like there's times when it's awesome and like I'm just crushing everything. And I've had a couple of sequences like that this year, which is why I'm doing pretty good this year. But in October, I just had this string where like if my normal win rate is 50%, I was really just everything that could have gone wrong was going wrong, which happens. Like if I'm trading for the next 30 years, there's going to be multiple periods like that where everything is going wrong that can go wrong. I think it's really just understanding like this is all just a game of probabilities. Like if I have an edge on a setup, maybe if you're a random coin flipper, you have a 50-50 shot of winning every trade. If I see an A plus setup, maybe that means I have a 60% chance of winning that trade. Or maybe it's still 50-50, but maybe my payout could be a little bit bigger on that trade. So I think it's just acknowledging like, hey, if these were all 50-50 coin flips, like, listen, I just lost 8 coin flips in a row. And it's very, very tough as a human running your strategy when you have those like 8 in a row. I flipped the coin 8 times and it was heads every time. That's where you can really get down on yourself or lose your confidence or just think like, I don't have it anymore or whatever that is. And I think it's just you have to keep taking cuts at the ball and just keep going. And so long as your risk management is good and you're taking every stop, which I did, then it's really just, you just have to keep playing through it and, there's nothing you can do. But I think that's why most human investors and human traders just can't succeed because they can't really just see it as a probabilistic event. They see it as like, oh, this is a reflection on me and like, I'm just such a bad person now or a bad trader now. So I'm always trying to get better at that stuff, but this time I handled it pretty good.
Outside of the investing championship, what's sort of the end goal for you? Meaning, are you looking to get into the investment advisory world? Or do you want to launch your own fund or product? What's the thinking?
Yeah, my thinking, especially when I was younger, like, oh, going the fund route, starting a hedge fund or something like that, that would be really what I want to do. I think in this like new world of, social media and like digital and all that stuff, I would also love just staying on the retail side, just continuing to be a retail trader, try to be more and more transparent every year and just add more value to, people reading my Substack or any other services that I offer. And I think that would be a great route too. Like I love what I'm doing. I don't mind if that's just the full career, but starting a hedge fund would be awesome too. So I think my goal is I want to have the option to do both. But yeah, that's sort of where I'm at. I want to have options, but I like what I'm currently doing.
As you know, there's been a huge influx of retail traders post 2020.
Yeah.
And there's been a lot of the retail has been driving a lot of the flows, right? You talk about a few shares here, a few shares there, but en masse, now it ends up driving underlying assets. Has retail, from your perspective, changed the way that you trade, meaning the influx of the type of people that are playing the market?
Yeah, so I really hopped on social media, I think right as this retail boom was happening. And it was really my fiance that was like, "Oh, you got to get on Twitter. You're going to love it." And it's been a love-hate thing for me with Twitter. But to be honest, I don't really think they've changed the landscape at all. Because especially like a lot of people that you see on Twitter, they might have like 5,000 tweets in a year. They might have like all these followers. But they might be like trading like a $10,000 account, or like they might not be trading at all. Like you really have no idea, which is why like for me, basically everything I'm seeing on Twitter, I just assume that most of it is smoke and mirrors. So no, I don't really think they've changed the landscape one bit. I do think retail's getting smarter. Like I really believe that if you're a retail investor and you have a passion for the market and like you devote a few hours every night, which is what I did for many, many years. Like I just devoted a few hours every night reading, learning, studying, that sort of stuff. I think you can become like more knowledgeable than a lot of institutional traders and investors. So I just think the playing field is a lot more level. But because these retail people have less capital by and large, I don't really think it's changing a whole lot. I don't know.
I think one of the big differences, though, is that because you were off social media as you started this self learning side of trading, you probably went about it in a more structured way and thoughtful way than a lot of retail that has come in and self educated from the social media side.
Yeah, so that's crazy. Like a lot of people that join my Substack, like I have a Discord server as well. I throw them in there and I interact with a lot of traders every single day. Like it's awesome to get to know people in that way. But yeah, a lot of the things that I hear are just like bonkers in terms of like the false beliefs people have about trading and investing and like the time frame that they think they're going to find this success, and really just a lot of people approach this just from a poor man's mindset, honestly. Like that's really what it is. Like if you approach the market from the mindset of just like a bum on the street that's like begging for a handout or like looking for like a shot of whatever on the road, like it's just never going to work, never going to work. The odds are so stacked against you. Even if you're like in tip top shape on everything and you give your best, the odds are still stacked against you. So yeah, I think people that jump on Twitter to learn trading and they don't go to direct source material, like go to direct source material, like learn from the charts, learn from the news, learn from you know, books, like that sort of stuff. If you just try to skip over that, it's going to be really, really challenging. And or you have to have a really good filter on who you're going to information from. You might be able to do it like if you have a really good filter and you get a really good mentor or whatever that is. But by and large, like you're just going to pick up, garbage online.
So, what books or sources or mentors did you gravitate towards? I mean, it doesn't sound like you necessarily had sort of a formal course education, like well, we had the CFA charters. I mean, I take that back,
Yeah.
which we should touch on too. But let's talk about that sort of structuring and where you would go for information.
Yeah. So at first, for me, it was just Bloomberg and Wall Street Journal trying to learn business. and really just like, what's a good thing for a company and like what's a bad thing and like what does it mean if you miss earnings and like what tends to happen to your stock if you miss earnings, or like just really basic things like that. You can learn a lot just from reading business publications. And then for me, it was studying the CFA exams and kind of layering that in there. And that was for me, the CFA exams, when I first learned about it, I looked through all the books in the curriculum and I was like, wow, there's a book on FX, there's a book on bonds, there's a book on equity valuation. And I was like, man, like I want to learn about the market. So this, like, I got to do this. This is going to be awesome. So I came at it from that approach. And for me, it was just like, I want to learn. So I just used it as like a big learning opportunity. But what's interesting is I think with the CFA curriculum, and as you alluded to earlier in the conversation, like a lot of people just don't trust CFA charter holders or they think it's nonsense. I think it's because with fundamental analysis as well, if you take everything too literally, it doesn't work. Like you can't just like read the CFA books and then like, oh man, the secret to all the alpha, like I just learned all of it and now I've got the full package. And a lot of people expect that to be the case and it's just totally not. And so then they're like, oh, the CFA exams are worthless. But I really just think the CFA exams for me, I was taking those exams when I was like in my early 20s. It's just an amazing foundation to build off of. Like, time value of money, like basic valuation concepts, like basic business concepts, basic, corporate actions. You kind of understand that stuff. And then, like, you get a little overview of every market. To me, it's very valuable, but it's just not a silver bullet. So it's really like, people ask me, like, how much of the CFA exams do you actually use in your trading? And, I have some valuation templates I use. I do relative valuation, but it's always my own spin on this stuff. And I've kind of picked and chosen what I want to use. So technically, I guess you could say not a lot, but for me, like I would do those exams over again 10 times out of 10. Like it was awesome for me.
You mentioned valuation, which we should touch on a little bit because I'm sure you've seen that meme that's going around on X where it's like, here's a chart of Dogecoin, and there's a picture of somebody throwing out the Graham and Dodd book on fundamental analysis, the Intelligent Investor. Do valuations matter anymore, man? I mean, I gotta tell you, I am skeptical.
Yeah, that's a great point. I mean, I think relative valuation matters a lot more than, like an absolute valuation or a discounted cash flow. Pretty much all I do, like I haven't done a DCF analysis in forever. I think a DCF analysis could really work very well if you're analyzing like a REIT or you're analyzing a dividend paying stock. Like say your strategy is like, I want to find dividend growers and like add alpha in that sense. Then yeah, maybe a discounted cash flow, like that could really be helpful in your process if you build it out very well. But if you're someone that's like, I have an absolute return objective, I could invest in anything that I want. I just have to buy it and it has to move up for me. A DCF is probably going to be a pretty ineffective tool. So I definitely think if you find like assets and you group them together and you look at the valuation metrics associated with those like assets, I think you can definitely find some really good clues and some really good leads. So that's what I do. Um, and then as well, like if you find a company where it's like the valuation is very, very low, a lot of people are obsessed with PE ratios and they just go like, well, the PE is low, so that means it's better than this stock that has a high PE. But the PE ratio factors in how much the company's growing. And it factors in, the profitability of that company and how the profitability is changing as it grows or shrinks. So just looking at that one metric by itself does nothing. Like there's more pieces that you have to put together in the puzzle. But like for example, if there's a company that's trading at a very low valuation and you look and you see, okay, it's trading at a low valuation because it's not growing anymore. That's really good intel that you can get from looking at fundamentals. because then if that company, oh, they're putting in a new CEO to turn it around, that's a good clue. And then like, oh, and then they report a positive quarter of earnings, and now the company's growing a lot more. Then suddenly you have a catalyst. And then you can look at another, a table of stocks with a similar growth rate. And then you can start to develop a thesis of like, I think the stock could revalue significantly higher, whatever it is. And as long as you don't take any of these things too literally, and they're just ideas, they're just leads, maybe they're little sources of edge, and you really just understand that this is all still probabilities and coin flips, then I think you can really use valuation effectively. But I think where people get messed up is like they read security analysis. That book has probably led more people astray than anything else in investing. I remember I read that book and I was trying to use those techniques, and I was taking everything very literally when I first started, and it was just like first couple of years in the trash pretty much. So I really just think you can't take anything literally. You got to take this stuff and run with it and make it your own, and then you can make it useful.
Um, what books did you go to that you maybe read more than once that really kind of resonated for you?
Yeah, so I think when it comes to reading books, I really believe that you can get a lot more if you read like one really good book and you read that book 5 times in a row. You can learn new things every time you read it. Like it's crazy when you reread a book a second time. Like it's like you're reading a whole new book. So I love doing that. Like there's the Mark Minervini books. Mark Minervini is someone who started off poor, now he's rich. And that's really like the proof is in the pudding a lot of times. Like this guy's made a lot of money trading. He has a really developed system. Like, hey, maybe I should learn from that guy. So yeah, his books, I would say they are like gold. Like he has one, it's Think and Trade Like a Stock Market Wizard. That one I've read multiple times. Really, really good book. And then when you augment that with like things I've learned in the CFA curriculum or things I've learned elsewhere, like things I've learned on the charts, news, all that stuff, you can really make it your own. So I think those Mark Minervini books are just fantastic. Um, and then there's been some really good books on market profile, like for technical analysis. Like I believe it's Jim Dalton has a really good one. It's Markets and Profile. That one is really, really good. And then the one I read most recently that I will be reading every single year moving forward, it's called Best Loser Wins. And that one is so good. And the main idea is just like almost everyone loses in trading because they don't take their stops and they add to losing positions. And that's like the main idea of the book. It's such a simple concept, but it's like the holy grail of trading. Like just taking your stops and not adding to losers. And like you just can't blow up if you don't do that.
How much do you think about the market averages when you're playing with individual positions? Meaning, are you saying to yourself, "All right, the Dow, the S&P look like they might tumble. As much as I'm bullish on this single stock, maybe I shouldn't buy into it." Talk about sort of the big picture averages versus the micro individual stock picking.
Yeah, I always start with the big averages. It's like I always start with bonds. Like I love treasuries. I love trading the TLT ETF is one of my favorites to trade. So yeah, I always start with TLT and really just like treasury futures. And then I always go to equity indices. It's like S&P 500, Nasdaq, Russell 2000, Dow Jones, and then I also add in the ARK Innovation ETF, even though it's not an index. I just throw that in. But yeah, I think they're very important because we've got a couple of really big mega cap tech stocks that dominate the S&P 500 and they dominate the Nasdaq. So if you're just looking at those two indices, you can get lost in the sauce. Whereas the small caps, they could be doing something completely different. So I spend a lot of time looking at the indices. I found over time I'm not so good at trading the indices. I do better with individual stocks, but I always start there and I always have them on my screen. But yeah, now the concentration has gotten so crazy that you need to look at the indices, but then you also need processes for looking at, like sectors and individual stocks and all that stuff.
So I got to ask, what's your sense of where we are right now in terms of market averages, in terms of post-Trump trade optimism? I mean, it's this is the question that always everybody asks, and nobody ever really knows.
Yeah. So where I think we are, like from a risk reward standpoint, is we got the big rally on the Trump win. And to me, that was like, I'm not going to say obvious, but that was very high edge. Because if you looked at like the VIX and the VVIX, they were so bid up into the election. And if you just listen to the narratives, like it was like, oh, we're going to have another contested election. Like what happens? Everyone was very prepared for that. And so, yeah, the election comes and goes. None of that happens. So when you have, volatility so high and just no risk event manifests, then boom, you get this powerful impulse move. I do think as well, when you get to the end of the trading year, like where we are right now, like Thanksgiving is coming up, Christmas soon after that. What I have found is when you have a nice positive year of performance, like I think the S&P is probably up like 20 to 25% on the year at this point. Once you get to the holidays, like I remember working at Vanguard on the fixed income trading desk, everyone starts taking vacation. And like I was a more junior person on that trading desk. So it would be like, oh, I'm still working here, but like there's no one else on the trading desk. So yeah, I think most of the big decisions are happening, maybe leading into the election. Over this past week, we saw a huge move in the market. Like those, I think, are like the last bets being placed into year end, everyone getting their positions on. There's window dressing that happens. People that were under invested, they have to get invested, that sort of thing. I really just think now is a time to coast. Like I don't really think it's like time to gear up and look at the chart for the full, 6.5 hours a day and like look for something. I think the dominant trend is up. So even if the indices like they consolidate, they pull back, I really just think that dominant trend is in place. I think the only things that could really hurt that trend is we've got the CPI coming up on Wednesday. We've got Nvidia earnings on November 20th. Those are really the two big events. I think beyond that, like you can just coast and you got to use that time to actually like enjoy, family time and that sort of stuff. Like it's, in my opinion, it's over. Like now it's time to start thinking about 2025.
Biggest piece of advice you'd give new traders starting out right around now would be what?
Ah, man, I think it would be start slow. Start slow. Don't trade with like your entire net worth. Go very, very slow. Try to play for a marathon because like all this stuff that happens in the market just repeats over and over and over again. Like big rallies, they happen a few times a year. Big sell-offs, they happen a few times a year. These things, meme stocks running happens a few times a year. Traders blowing up as it all reverses happens a few times a year. So just take it slow. There's no such thing as like a missed opportunity. There's always another opportunity. Like, yeah, I think my high level thing would be just, take it slow, try to play for the long haul.
Andrew, for those who want to track more of your thoughts and read more of your work and get in general, uh, just follow you around, where would they go to?
Yeah, so you can follow me on Twitter. My handle's at real pristine cap. And then I have a Substack. It is pristinecapital.substack.com. Every night I do my nightly research that prepares me for the trading session ahead. And I always post that on my Substack. We've got a good Discord community as well. So yeah, feel free to sign up. There's a free version of that. So love to have you on.
But yeah, please make sure you follow Andrew. Check out his Substack. Very thoughtful, as you can tell. It's certainly not one of those guys that just says, "Oh, I'm the best and I'm such a great trader," and buy my book. I actually very much enjoyed the conversation, Andrew. Everybody, please make sure that you follow him. Spread the word around Lead Lag Live, given the sheer amount of time and effort I put into these shows, and hopefully I'll see you all in the next episode. Thank you, Andrew. Appreciate it.
Thank you so much, Michael. Really appreciate it. Looking forward to chatting soon.
Cheers, everybody.